This is Blue Nile. Today, we'll break down the basics of liabilities in financial reporting and auditing. Liabilities represent a company's obligations to pay debts or provide services in the future as a result of past transactions. They are a critical part of the balance sheet, reflecting the financial commitments of a business. Key types of liabilities include current liabilities, obligations due within a year, such as accounts payable, short-term loans, and accrued expenses. Non-current liabilities, long-term obligations, such as bonds payable, long-term loans, or lease liabilities. Auditors focus on assertions like completeness, ensuring all liabilities are recorded, accuracy, ensuring amounts are correct, and cutoff, ensuring they're recorded in the right period. Proper identification and evaluation of liabilities are crucial for presenting an accurate financial position. Let's get started with our tutorials. This video will give you some practical examples in how auditors would audit some of the liability balances in the financial statements. We are going to discuss the audit of accruals, provisions, other payables, and trade payables. Auditors must assess the risks associated with balances being materially misstated at the start of the audit when planning their audit procedures. The concern with liabilities is that the client may have understated the balance to make the business look healthier and more liquid than it is. With this in mind, the key assertion being tested is completeness. Other important assertions to verify are rights and obligations and evaluation. The accruals balance will have been prepared by the client based on costs that may have not yet been invoiced in the year but belong to the current year. The auditor should obtain a breakdown of the accruals balance and ensure it adds up and agrees with the accruals balance in the financial statements. In addition to this, analytical procedures are useful here, as this is a balance where estimates have been used and judgments made by the client. It is open to manipulation. Therefore, key analytical procedures include comparing the accruals balance to last year and investigating differences, and review invoices dated after the year end to identify if the cost belongs in the current year. Anything found should then be recorded as evidence and discussed with the client for possible amendment. Provisions may be included in the financial statements. The client needs to ensure they have followed IAS 37 provisions, contingent liabilities and assets correctly. It is the auditor's job to review the evidence and decide whether a provision should be included. Provisions could arise from events such as potential compensation payments from court cases. Remember the rules from the standard. If there is a remote chance of the client suffering an outflow of resources, then there should be nothing included in the financial statements. If there is a possible chance of the client suffering an outflow of resources, then there should be a disclosure note called a contingent liability note, explaining the possible event, but still no provision. If there is a probable outflow of resources, then a provision may be included in the financial statements, and a disclosure note explaining the balance. There are 3 criteria that must be met for a provision to be allowed. There must be a present obligation due to a past event. There must be a probable outflow of resources. And there must be a reliable estimate. The final criteria is the sticking point. The auditor must gather evidence to be satisfied that all 3 criteria are present if a provision has been included. They must inspect correspondence, for example from the company lawyer, and also discuss the event with them. They can inspect any other external evidence such as press reports if it relates to a court case. They must then obtain evidence on the estimate of costs and ensure it is from a reliable source. This can be a lawyer, but must not be an estimate from the client management. Other liability balances include sales tax, employee tax, payroll, and bank overdrafts. For each of these, there is a piece of external evidence that can help verify the balance in the financial statements. The bank statement. Agree each of these balances to the bank statement, as the payment should be shown after the year end. If not found, or if it does not agree, the difference should be discussed with the client. The only exception is the bank overdraft. This may not completely agree with the bank statement, as there may be timing differences. The same procedures will be applied to this balance, as we have already discussed in the second video in this series looking at current assets. The bank reconciliation will also play a part in verifying the bank overdraft balance, along with the bank report. Trade payables is the total balance of all outstanding balances owed to trade suppliers. This could be a significant balance with many transactions, and therefore, several audit procedures will be carried out on many transactions selected. Audit procedures will include cut-off testing, reconciling supplier statements, post-year-end invoice review, and some analytical procedures. As the payable balance is made up on purchase invoices, it is important to ensure that the invoices have been recorded in the correct period. The auditor must therefore review the invoices posted just before and after the year end, where the risk of misstatement is higher. The procedure would be to identify the invoices posted just before and after the year end, compare them to the goods received note, review the delivery date, and ensure the invoice is posted in the correct period. If the delivery date is on or before the year end, the purchase and liability belongs this year. If not, it belongs in the following year. The client would receive supplier statements from the suppliers, which will show the transactions such as invoices and payments made and the outstanding balance. These are usually sent monthly. The auditor should select a sample of suppliers and reconcile the supplier statements sent at the year end to the ledger. Timing differences, such as invoices sent but not received at that point, are acceptable. But any other differences that cannot be explained should be investigated with the client. As completeness is an important assertion, the auditor must be satisfied that all transactions have been included. Therefore, inspecting purchase invoices since the year end and reviewing the detail will be required to ensure that there were not any invoices that should have been included in the current year. There are a few analytical audit procedures that can be carried out on the trade payables balance. These include comparing the balance to the previous year and investigating any significant differences, calculating the payable days ratio and comparing to the previous year, identifying the trade payables balance for each month and comparing the level of payables to the expected trend of the company, and inspecting the aged payables analysis. In particular, identifying the old and slow-moving balances and investigating these with the client. In summary, we have looked at key liability balances that are regularly seen in the statement of financial position. When auditing liabilities, the key assertion is completeness, as it is possible the client may manipulate figures to reduce liabilities and costs. Analytical procedures are a very useful tool when reviewing these balances, and reviewing transactions and events after the year end should not be overlooked, as this may identify potential liabilities that have been missed. I hope you have found this video useful. The fourth video on the audit of specific balances will cover auditing balances in the statement of profit and loss, including directors' transactions, and equity and reserves.